Estimated financials for 2010. Our audit happens in the summer, so these are all estimated numbers. Sponsorship at $123,000, membership at $65,000, and income, miscellaneous income at $6,000. Job board and the lens shift. Job board we made free about a year or two ago, so there's no income there. For a total of approximately $194,000. Expenses, $36,000 mostly for our evening events. Management staff, $129,300. Miscellaneous bank fees estimated at $7,000. Professional fees, mostly accounting, $9,000. Miscellaneous fees, the FAOY dinner expense exactly at $41,525, and website updates at $8,000. So a deficit of about $40,000 this year. 2011, we're estimated to be in the black again as the world gets better. Approximately 688 members at the end of 2010. IFE still doing about 20 events a year, including some tutorials, etc. New membership level, young practitioner at $100 for people under the age of 30. Member-only sessions, and also the members-only section with videos of past events and auto registration. Fisher Black, introduction of the academic affiliate membership for MFE and related programs, and how it became a quant continues to happen in about 10 cities a year: Ann Arbor, London, Boston, Chicago, Toronto, New York, of course. And the book co-authors, which are in the room, or co-editors are in the room, has been published into Chinese, Korean, and I believe Japanese by now as well. And that's it. Are there any questions? Okay. Thank you. Richard.
There being no questions, I will close the meeting of the 2011 meeting of the IAFE. Thank you.
To the 19th annual conference. So we're 1 year away from our 20th. Before we get started, just a quick couple remarks. For those of you who come to a lot of IFE events, you could probably read these by now. It's sort of like reciting what happens on the airplane, the security procedures. So first of all, the IFE press policy is that all IFE events are off the record. They can be reported on generally, but no attribution of quotes. If there's any members of the press who would like to speak to the panelists afterward, you're welcome to approach them and see if they want to go on the record themselves. The next comment contradicts the first one, is that this event is being video recorded. Certain sessions of the event are being video recorded. This is for the benefit of IFE members who are not in the room today. A lot of our events will be recorded. I know this session will. Certain ones will not be recorded today. In a few weeks, they'll be streaming on the IFE website in the members section of the website. I'd also mention that all of the panelists today and throughout the day are speaking on behalf of themselves and not necessarily the views of their company. And also a quick thank you to NYU for hosting us, the math program at NYU, and also to our sponsors, the University of Hawaii Schindler School of Business, their Masters in Financial Engineering program, and the Haas School of Business, their MFE program as well. So we'll go with this at 10:30, and we'll have a good day, and I look forward to it. If any questions about the IFE, please see myself or a member of the IFE staff. With that, I will turn it over to Peter, who will be moderating this morning's session. Thank you.
David, thank you very much. My name is Peter Nicolescu. I'm the moderator for the panel this morning. I'm a partner at Capital Market Risk Advisors. We specialize in risk management consulting work and litigation support in financial matters. What I'm going to do this morning with your panel is, first of all, give you a brief introduction to the Exa Rosenberg SEC settlement matter, and then ask each one of the panelists to introduce themselves. And having done that, each one of our panelists has a few minutes of remarks they'd like to make about the matter, and I will also. We will turn to an interactive session with the panel that I'll lead for a few minutes, and then toward the end of the session we're going to open it up to the floor for questions from the floor on this matter. So the SEC Exa Rosenberg settlement was the result of a process that began with a coding error at Exa Rosenberg that apparently occurred in April 2007. As you know, Exa Rosenberg is a very large, quantitatively oriented investment operation. It's perhaps the iconic or first major quantitatively oriented investment operation of its type. Bar Rosenberg had become something of a legend in the industry. And in this situation, there was unfortunately apparently a material coding error that was made in an update of a model in April 2007. And the details are not terribly important, but it appears as though a coefficient was miscoded to a couple of decimal points. This was not recognized or realized until June of 2009, when people began to realize within Axel Rosenberg that there was an error. It was not disclosed externally. And in fact, as late as October 2009, senior people within Axel Rosenberg denied that they were aware of any such error. It was realized internally to a senior level by November 2009, was disclosed in 2010. The SEC took a very dim view of those proceedings, and ultimately a settlement was agreed between the SEC and Axel Rosenberg, which resulted in AXA making payments of some $217 million to investors. About half of their investor base was affected by the error, and the calculation of the reimbursement was done as of the date of the error's inception back in April 2007. Somewhat controversial in many ways. They also paid a $25 million fine. That was the result of the settlement, and they have appointed an independent third party to look at model risk and reporting. Rosenberg, the chairman, had to leave the company. The research director also had to leave the company, and they have lost very substantial assets under management. So those are the basic facts, as I understand it, of the matter. And I think the questions that it raises for the quantitative investing community is, at this point, really, what are the standards? What are the standards under which quantitative modeling is to be held? From a perspective of validation, a perspective of detecting models, a perspective of escalation and reporting models. And I think those are open questions and ones that given the settlement, have concerned a lot of people in the industry broadly. And we will come back to a survey that my firm did recently of investors on this topic in a few moments. But with that, let me turn over to Glenn Barentine on my left, who is from Cadwallader, and let them introduce themselves, and we'll go from there. Glenn.
Good morning, everyone. You're all to be commended for coming out on such a lovely morning, especially for such a fun topic. So anyway, I am an attorney at Cadwallader, Wickersham, and Taft. My practice focuses largely on regulatory issues involving financial service firms, compliance, trading issues, those types of things. So I'm going to start off my discussion with kind of a broader view of AXA in two respects. One is general concerns raised by model-driven risk. And two, I'm going to argue to some extent that this is not strictly speaking a model case, it's really a risk/disclosure case. So let's talk about the first issue. The SEC's view of model-driven risk. This is an area that I think the SEC has expressed a great deal of concern about. So you have safety of the market. So let's think, flash crash, algorithms gone wild. The SEC is very concerned about that. You have also concerned by the SEC that it's just bad for the markets, that people who do high-frequency trading, for example, are taking liquidity out of the markets when the market needs it the most and not providing liquidity when the market needs it the most. They also think that people are using technology to hide bad behavior, manipulation, for example. I haven't read very many things that seem to express how that manipulation is being done, but a lot of people who work for the press, and I believe a lot of people at the SEC are convinced it's there and it's happening. They just can't find it. The SEC has responded with Rule 15c3-5, which has imposed obligations on broker-dealers to, kind of look at all the order flow that goes through their pipes and make sure it's compliance with rules, et cetera, et cetera. And then there's also a fairness component. The SEC has said on a number of occasions both that they think a lot of the technologically driven trading, model-driven trading, is somehow unfair because long-term retail investors, it hurts those people. How it hurts them, I'm not really sure, but there's a lot of concern by the SEC. So this is an area that generally the SEC is uncomfortable with, not happy with. They think there are issues there. So that's just kind of a backdrop. So let's talk about AXA just for a bit. First, an obvious point. The facts in AXA as presented by the SEC are bad, and I'm going to make a general disclaimer. If I'm referring to facts or making assumptions about AXA's behavior, what I'm referring to is AXA as portrayed by the SEC. I have no independent knowledge. I am not making any claims as to what AXA really did. The facts are kind of thin in terms of the order, but I'm looking at kind of, this perhaps mythical entity portrayed by the SEC. So, no suggestion that this actually applies to AXA in any way or that I have any knowledge one way or the other. But the facts as presented by the SEC are bad. There's an allegations of what really amounts to a cover-up. They delayed informing anybody. They finally told the SEC when the SEC was really at their door, so they don't get any credit for, having a self-reporting, which is unfortunate for them. And so they come off kind of with weakness at the very beginning. Still, the question raised by AXA is there a legal duty? And if so, what is it? So, for example, is there a duty to disclose? There's a lot of language, particularly in the press release that accompanies the order, that I think, kind of hypes up the legal duty. It's not clear what the duty is, and I wouldn't rely upon a press release by the SEC in terms of my legal analysis, although it's somewhat relevant as to what the SEC is thinking. So in terms of looking at the question of whether there's a legal duty that comes out of AXA and what it might be, you have to step back for a second and think there are two classes of investors in the AXA case. One are people who are not investing but are being solicited to invest in a fund. This is no different than if any company goes out into the markets on IPO or a follow-on offering, and the duty or standard of disclosure with respect to those people is set forth in the 33 Act, and it's a materiality standard. You have to disclose all material risk, facts, etc. And so clearly, if you had an error in your model, an ongoing error in your model, and that error was material, the reasonable investor would be interested in knowing about that. You can't be going out and soliciting people to invest in the fund without disclosing it. I mean, that's kind of, I think, securities law 101. The more interesting case, there's a second group of investors, the people who are already invested in the fund. They're not being solicited. You're not going out and asking them to invest. They're already invested in there. And so the question is really, what is your duty to them? Because AXA could have ceased its efforts to attract new investors during this period. And would that have resolved the issue? No, it wouldn't have. But why not? So part of the question here, I think, is, here's the SEC's logic, I think. And in my mind, it's a bit strained, though I'm not sure it breaks. But it goes like this. You have a rule 20647 under the Advisors Act, and that rule requires that advisors adopt and implement written policies and procedures reasonably designed to prevent violations of the Act and the rules thereunder. Okay. The making of false statements to clients and investors violates the Act. Okay. So QED, a firm's rule 20647 policies and procedures must be reasonably designed to prevent the making of false statements to clients and investors. All of that seems fair. That seems right. It's one of the requirements. You have to have policies, procedures reasonably designed to comply with the requirements. But then the next step, which I think is a little bit of a jump, but as I said, I think it kind of bends but maybe doesn't break, is where a firm makes statements to clients and investors regarding its models, the firm must have policies and procedures to ensure that such statements are true. And I think that's kind of what AXA says. And I think there's some qualifications there. But if you make a representation to a client the function or process to which that representation relates must itself be subject to policies and procedures that comply with Rule 20647. Now, some qualifications. We're probably talking about materiality. We're also probably talking about omissions. I mean, if a reasonable client would think that you would represent something if it existed, and so the absence of a representation can be taken as a statement that it doesn't exist, an omission, then you probably are deemed to make a representation implicitly. So one question this raises is, could you just disclose, my model is horrible, it's buggy, it's filled with errors, it doesn't work. Potentially has obvious downside, but potentially that might be one solution. Probably not the solution everyone wants to adopt, but you should be careful in terms of your disclosures and make sure that you have all the disclaimers and all of that type of stuff. The question I think is really actually, the real question is, does AXA start and stop with quantitative models? And I think the answer is no. AXA doesn't really have anything at all to do with quantitative models. That's what caught the SEC's attention, but the logic of AXA really applies to any function performed that is or should be represented to clients, i.e. a material function that has significant risk associated with it. And so, where do we end up with this? Again, I think it's kind of a risk disclosure. And I'm going to read a quote. I was looking at something this morning. I was on a very slow train coming in and catching up on my reading, and I saw this quote from about 2 months ago from Mary Shapiro, and it said, "She promised that our examiners, the SEC's examiners, intend to focus on understanding how risk management is embedded in key business processes and decision-making at a number of levels. They may ask, for example, whether key risk management control and compliance functions are embedded in the business process and funded adequately." So what I think AXA really kind of says is you have to have a risk program. You have to look and see where your material risk is. You have to look and think about what are the controls that you should put in place with respect to that risk. You have to think about how do you disclose that risk to your clients. You have to have an escalation process so that if something happens that is not what you expected, that you're aware of it, and then you can again make the decision, how do you disclose that, what steps do you take. And you have to have somebody, AXA talks a little bit about this idea of compliance people in some way being embedded in the modeling group, which frankly seems a little crazy to me. I wouldn't want that job as a compliance person. There aren't that many compliance people who would be qualified to do that. But I think if I try to make any sense at all of that, where I come out is you have to have a control function, potentially compliance, that's kind of monitoring this, making sure that it's there, that the process was a reasonable process, that the process is being followed. They may not really understand it, but they'll sit up and make sure that the process is there. I kind of think about it as a lot of operational functions, the procedures that you have in terms of protecting client confidentialities, client information, et cetera. A lot of this very technical, very operational, but still you have to have a control function that is independent and looking at it. And so that's kind of what I think AXA says in a nutshell.
Thank you very much. We're conscious of the time. Let's move on to our next panelist, and we'll come back to you with questions in a minute. Barry?
Sure. Hi, Barry Schachter. I'm the Chief Risk Officer at Woodbine Capital. So Glenn gave me a great way of starting because I find appealing his conclusion about interpreting AXA, that it's not the way you would like it to develop over time, is that AXA is not about modeling so much as it is about representations that are made to clients, disclosures that are made to clients, and then policies and procedures internally that affirm that those representations are actually things that happen inside the firm. And the reason why I like that interpretation is that there are many other interpretations possible of AXA that are a lot scarier and more more open to, very large costs of compliance and a lot of variation in interpretation. I think that's one of the big things about the Axel-Rosenberg order, is that there's a sufficient amount of ambiguity in what was intended that there may be a tendency to respond by overcompensating for what the perceived issues might be. And I think that's bad in a number of ways. And I just want to quickly mention a couple of things. I think they'll come up again and again. One of the questions is what does Access say about what constitutes an adequate compliance program? And as Glenn said, there is at least one statement in the order which really seems to impose enormous responsibilities on compliance. But I'm going to pick one sentence from the order that I think is particularly interesting. Quote, because the compliance program did not sufficiently identify and mitigate the risks, the coding error operated undetected for more than 2 years. Okay, if any of you went through a PhD program in economics, you probably learned about something called the post hoc ergo propter hoc fallacy. What's going on here is a manifestation of that in a kind of insidious way. I think we probably all would agree that any big complex computer program has bugs in it, and that some of those bugs are undiscovered and probably have been undiscovered for years, and some of them are never going to be discovered. The implied assertion of a causal relationship that the inadequacies of the compliance program were responsible for the coding errors being undetected for more than 2 years is really an improper, places an improper burden. The implication being that any coding error that somewhere down the road is discovered and at the time of discovery is determined to have had some material impact was the fault of a previous decision on what was an adequate set of compliance policies and procedures. And so you're actually kind of like turning logic on its head if you interpret it that way. So I think one of the things we should do is fight against that particular interpretation, that it was, that because there was a coding error, we know therefore that the compliance program had to have been inadequate, okay? And in fact, there's a very famous non-error message that comes out of a code testing program that some of you are familiar with called Bugzilla, which says something like, run completed, run completed, 0 bugs found. So I think that's one issue that we really need to think about. And the second one is, even within the context of modeling, we don't want to expand, I think, we don't want to expand Axel-Rosenberg beyond the context of coding and the issues surrounding model updating and model implementation and control of model code. We don't want to expand it to broader issues of what's a right model or what's a wrong model, because that just raises a lot of very scary epistemological issues if you happen to be a philosopher of science, but if you happen to be a practitioner, a gigantic can of worms, because we don't really know what a correct model is in the sense of the accurate depiction of reality. We use models because of their ability to provide seemingly useful answers to questions
Well,
that
yeah,
we
I mean,
have.
this strikes me as really a heart of a point, maybe not the point, but a model by definition is a abstraction from reality and therefore is by definition wrong. So given that as the precept, where do you go to define an error?
Yeah, maybe we'll talk about that a little bit more. The assertion that a model by definition is an abstraction of reality is actually a particular statement about your view of models.
Fair enough.
But yeah.
Fair enough.
So anyway, so I think these two things are potential areas for being very vigilant in terms of the way we choose to respond to Axel Rosenberg. And I hope we do talk about that more.
Giovanni.
Oh, thank you. Giovanni Bigliossi, I'm London-based. I run a quant investment management shop, not quite the size of Axel Rosenberg, either before or after the act. Brought with me a souvenir from London. I had hoped that because the conference is sponsored by the University of Hawaii, that would have some impact on the weather. I think, David, maybe next year is something that we look at improving upon, the link between the two. I should stress that nothing of what I'm going to say, either in my remarks now or what I'm going to say in the Q&A and in discussion, represents the views of the IFE, of which I'm a director, nor indeed the views of my own firm. So I'm kind of rambling along on my own on this. What I thought I'd bring is a bit of a European perspective, and then towards the end of my remarks, a bit of a perspective of an asset manager that uses quants as its tool. Why a European perspective? Because in Europe we had a situation that seems to be a bit what the other speakers have mentioned, in which there was a regulatory interest for a particular area or set of issues. Like in this case, there seems to be a concern with quant management in general, from high frequency now to traditional quant by the SEC. In Europe, a couple of years ago, there was a concern about the hedge fund management industry as a whole. And so signals and noises were made by regulators of various places, security regulators, as well as legislators, especially in Brussels and in some of the European capitals, to the effect that some regulation was going to be imposed at some stage. So the industry thought that a good idea there would be to self-regulate in some ways. And some very, very good attempts were made. And I'm going to talk briefly about those attempts to see if this could be an option for the quant industry to try and discipline itself ahead of a potentially disrupting regulatory action that may or may not happen. We don't really know, but some of the signals seems to be there. So what happened in Europe 2 or 3 years ago was that the hedge fund industry organized itself into something called, I can't remember the original name, but what is then become the Hedge Fund Standards Board. And so the representative for hedge funds, EMA, or one of the representatives for hedge funds, EMA, that is locally prominent and predominant in terms of its membership, got around it a bunch of very qualified large institutional investors, managers, and service providers. And basically, to cut a story short, and then again, this is my interpretation, of course it will happen, and not EMA's, got them together and said, let's try and work out a set of good practices and a rule of codes that we can self-enforce in some way, so that maybe that's a sensible approach to either avoid heavy-handed regulation or direct it in a way that is sensible for the industry. And again, that took form of the Hedge Fund Standards Board, and it's quite interesting to see what happened later on. So this took form. It didn't quite have the big follow-up with hedge funds, especially in terms of subscribing to the standards and the self-regulation there was in terms of numbers, but certainly some very high-profile funds subscribed to what was required, with implications in terms of the compliance, risk management structure that was put in place, and trading structure that was put in place. A few of the consultants then started certifying people for adherence to the board requirements. The adherence to the board or the membership of a board was voluntary by hedge funds, but once in, you had to state that you were that you were basically satisfying the requirements and the procedures and the principles. And then what happened was, all of this went into place, and then what happens was, post-crisis, it sometimes happens, I think, where regulatory matters, out of a totally unrelated set of circumstances, that were mostly, again, related to an interpretation of a crisis that placed some burden on hedge funds without much evidence, and really out of an initiative that didn't come from the securities regulators, but really came from the legislative part of the European Parliament in many ways. Then regulation stepped in, again, from a totally different source from the one that was envisaged. And what happened was the effort that had been done with the Hedge Fund Standards Board, this is my interpretation of that, of course, didn't quite succeed in some way avoiding or molding regulation in a sensible way, fully in a sensible way, but it did succeed in getting a few things in place. That is, a seat at the table, and certainly few views by EMA and by the constituent parts being heard in Brussels. And the result is that the AIFMD, which is the directive, the European directive that is binding for the underlying member states on hedge fund managers, is now a lot different from what was envisaged by the politicians who put it forward as a good idea back at the beginning of 2009. So I think there are a few lessons to be drawn there. There is an effort that the industry can make, but it has to be an effort in the presence of the right players to push, that can push it forward. In that case, there was EMA, there were big hedge fund managers that were convinced that that was a good thing to do, and there was a set of sensible procedures and rules and enforcement procedures in place so that that could be enacted. My question is really is, and I don't really have an answer for it, is whether this is or could be the case for the quant community. Who can take that role? Do we want someone to take that role? Who can take that role? Can a set of sensible procedures and principles and guidelines be put in place? And again, I'll refer towards the end of my talk to an experience that, again, is part of the IAFE and my experience with the IAFE, and it's the reason why I said this is totally personal comments. There were a couple of instances in the last 10 or 12 years in which we have produced, as an organization, suggestions in terms of transparency, disclosure, and valuation. And what we've been, I think, quite careful to do was to make those suggestions, i.e. things that people can talk about, can discuss, not replacing anything internal, that is discussions between managers, investors, and people internal to the firm, in terms of what makes sense, in terms of transparency, disclosure, and valuation. Just points to discuss. And why did we do that? Or at least, again, that's my interpretation. I remember some of the conversations within the various committees that did that within the IFE, was you need to be quite careful when you start talking about standards. Because when you start talking about standards, then you establish principles, and then you need to substantiate them and police them. So there's both a judgment in terms of the content and form of the principles, and there's a big call in terms of who's going to police them when you have standards outside. And those are some of the, I think, critical aspects to the quant community at large, in case an effort of trying to find principles and police them. Standards and police them, as opposed to just rallying around principles and ways of doing things. Final note, really as a quant manager, so I said more questions than answers, just a couple of observations. Of course, as a quant manager, you have to stand up for what you said to your clients, and you kind of deceive them or hide behind numbers, or hide behind statements like, oh, it was only 3 or 4 basis points. And I think there's been some of it that maybe, again, following what the SEC says of a case, because I, like my fellow panelists, I have no claim or inside knowledge of this or personal knowledge of any of this. However, a question that has to arise, and I'm talking as quant manager, on whether quant managers are then subject to higher standards than others from a regulatory point of view. Because I can imagine a number of cases and circumstances in which something quite similar would have happened to a non-quant house, and it would have been maybe treated in an analogous way, but not really pursuing it in a way or another, and wouldn't have attracted any interest from a regulatory point of view or from a client, respect of your client duties point of view. So again, I'm sorry I'm not leaving you with conclusions more than leaving you questions, but those are the points that I thought I would make.
Giovanni, thank you very much. No, I think that last point in particular resonates a great deal with me about the question of whether the quant industry, the quant business, is being treated a little differentially in this matter. My firm, CMRA, did a survey of investors fairly recently in the wake of the Axel Rosenberg SEC settlement on this topic, on the error topic. And I wanted to give you a couple of highlights from that, and then go back to our panel and ask them some more general questions. We surveyed about 150 investors. About half were identified themselves as quant versus non-quant investors. And what I found was interesting, one of the things I found was interesting in the survey results was that there was a fairly even split between those who really take care of model errors, worry about them, disclose them, track them, and those that don't. And we asked a variety of questions, but that split showed up throughout question after question. So, for example, we asked questions: do you track model errors? Do you escalate model errors? 41% of our respondents said they do not track or escalate model errors. Therefore, I suppose about 60% do. We asked if people have a model review policy. 2/3 said they did have a model review policy. We asked if they had an error disclosure policy. 49% said that they do. We asked if they have an independent quality control group to look at models and coding. 48% of our respondents said they do have an independent quality control group. That was a little lower than I was expecting to see. We asked whether people test versus documentation. 69% said that they do, which I was a little bit more encouraged by. And then we listed a set of possible changes, going to this question of what is an enhancement to a model and what is the correction of an error. Went through a list of 13 possible changes. I won't read them all out to you. One of the things that struck me as interesting is that the respondents, to my view, seem to be quite conservative in viewing a wide range of changes of a model as a correction of an error. So, for example, I wasn't very surprised by the response to our first question. Your investment model has an expected return of 100 basis points, a standard deviation of 200 basis points. It's run unchanged for 2 years. A QC person just discovered a model implementation error that lowers, if corrected, lowers the standard deviation by 20 basis points. Doesn't change the expected return. Is that an error? Well, yes. Almost 90% agreed it was an error. It may or may not be material, but they agreed it was an error. On the other hand, ask a very simple question. You've decided to add a skew to a model that's been in operation. Is adding that skew a correction of an error, or is it an enhancement? Of our universe, 42% said it was a correction of an error. That surprises me, that we have that broader sense of what an error is in this world. Adding a new relevant index that had been actively traded but not included in the model, is doing that correcting an error? 37% of our respondents says it is correcting an error, which again, it surprises me fairly considerably as to what we think of collectively as a model, as an error, and as a correction of an error. Let me turn to the panel. Glenn, you said a couple of things that I thought were very intriguing at the beginning, and I appreciate very much the point that the SEC is perhaps more focused on disclosure and compliance than they are on modeling. But I also heard you say that they have been very concerned with the flash crash, with models gone bad, high-frequency trading, using technology to hide bad behavior. That sounds a lot more like an anti-quant model bias. And it's particularly intriguing in the sense that of all of the modelers out there, Axel Rosenberg is probably the definitive long-horizon fundamental investment model. It's not the high-frequency flash crash type model. Can you kind of square that circle for me here? Is there, in fact, underlying this some sort of in your opinion, some sort of an anti-quant model bias at the SEC?
let me say one thing. I mean, orders do not make law. They're not like court cases. They're not common law. The SEC enforces the law, which is the statutes that Congress approves or the rules that they approve pursuant to the Administrative Procedures Act. So the SEC cannot make law with this case, which is to say that when you really try to figure out what is the legal standard that this case is, you really have to look at the rules that are being cited by the SEC and what do those rules provide. And so that's kind of how I get to this thing, that it's not model-driven. It's really this risk and disclosure issue. Having said that, the backdrop of this is all things kind of, computer-related gives the SEC a lot of concern. High-frequency trading gives them concern. Anything they don't understand really gives them concern, and they don't know what people are doing, and they don't know if investors really understand the risk. And so, and the other thing is that when a nice case is kind of teed up for enforcement, they run with it. The SEC is fundamentally an enforcement agency. That is how I think they really see themselves, how they view their job. They are run by enforcement cases. So you got a great case. They're going to run with it. It has some aspects of things that are concerns to them. What the broader principles are, time will tell as to kind of what we see the SEC doing, what future cases are, what they say, that type of thing. I don't know if that really, I don't know if it's possible to kind of square it, but.
Yeah, I understand. So let me try an example. Let's contrast the X-Rosenberg case with a purely fundamental non-quantitative modeling operation, where you have, let's say, an analyst who's following a set of companies, and he's been following one for a couple of years, and he's modeled out their cash flows and their revenues, and after a couple of years he discovers there was an error in his modeling spreadsheet, and that changes his opinion on the company. Now, is that an event which should, how would you think the SEC would view that? Should his company reimburse his investors for that model, as happened in the X-Rosenberg case? I
mean, the starting point on all of this, in my mind, is, what's the disclosure that advisor has made? What's the materiality of that? You kind of have to start with those two things. But clearly, if you've given investors a sense of that you're doing something, and this is material, I think you do have to think hard about, do you go back out and correct this? It's probably not the sexy case the SEC is likely to bring. But could they bring a case? The theory, I guess, of AXA, I would read AXA as saying that they could. I would read AXA's view of the Advisors Act and the rules under the Advisors Act as saying they could, depending on materiality, depending upon disclosure, depending on what a reasonable investor would think. There's a lot of facts and circumstances here. The one thing I would add real quickly is, in some way, the ultimate answer, I don't think, is necessarily what I meant, where I go. Where I go is, what is the process you put in place so that when the SEC comes in and looks at it, they don't immediately jump to AXA Rosenberg, but they look at it and they say, responsible firm, trying to deal with things responsibly. They had controls, they're trying to do the right things, and they don't instantly kind of start thinking, wow, this is a great enforcement case. You want to keep them from getting to that point so that you're not facing the ultimate questions and answers.
Well, I think you're getting to the very question I wanted to really pose to the whole panel, which is and I'll start with you, Glenn. In your opinion, what is it that investors should be putting in place now to protect themselves in the aftermath of AXA Rosenberg, given what we now know of AXA Rosenberg? And your answer is partly a compliance process, but could you elaborate on that a little bit?
Yeah, I'm very process-oriented. And so I think you want to have a overall risk management program for your firm. You want to document that risk. You want to have important people, knowledgeable people on both the business and the control side who are involved and looking at that. You may want to bring in, depending on how all of this based on materiality, how important this is, disclosures, those types of things. You may want to think about bringing in outside consultants. Now, I've talked to several of my clients, and they would go, we would rather cut our arms off than show anything that we're doing to outside consultants. But at a high level, in terms of a process management, that type of thing, controls, et cetera, kicking the tires, not necessarily looking at the coding. So you want to document, you want to create and document a process, and you want to monitor that that process is actually complied with. And what's a reasonable process, what the process should be, you know, I think if you really roll up your sleeves and think about it real hard from the perspective of your firm, you'll get a long way there if you act in good faith and really make, you know, people at the top of the firm make this a priority. I think you'll get a long way there in terms of designing something. Can it be improved, and should you be talking to industry groups and all of that? Probably. But I think that's the starting point.
There seems to break into several components, if I can, and I think different people have touched on this. I mean, one is the model validation itself. I mean, did you write something that is actually valid, that you like, that other people independently as peer reviews think is credible? Secondly, was it coded correctly? And thirdly, what are the disclosure, escalation, and what policies do you have in place if something goes wrong? You know, on that point, Barry, you made the point that the compliance program did not find the error. Was one of the statements in the SEC order, which, yeah, I agree, it's a sort of a frightening statement for a quant to read. It strikes me as an open question how, in the wake of Axel Rosenberg, how we should go about testing models and model implementation. You know, having an independent consultant come in is not going to be acceptable to most people. But you obviously are not in a position where you can rely on the individual modeler and developer to do his or her own testing. What do you think the right answer to that is?
So I'm going to answer that with maybe a couple of other questions instead. It's actually a really tough question that you're asking, and I think that so here's a couple of questions that I deal with. Sort of have taken it as an article of faith in the non-quant area where I'm dealing with discretionary proprietary risk takers, that they, whatever, and this is not to cast aspersions, but whatever kooky model they happen to have on their desk for the purposes of helping them make their subjective, discretionary decisions are things that I am not going to subject to testing, simply because they're responsible for their P&L. I'm responsible for making sure that they stay within the parameters of their trading style and risk guidelines. If they choose to adopt strange models as indicators of when to buy and sell, that's kind of their choice. And if those models do not prove themselves, then they're not going to be around very long and won't do much damage to the firm. So it's an interesting question about whether, you know, I need to go back and change my attitude on stuff like that. I can tell you that it would not be received well on the part of those discretionary risk takers if I told them that I need to evaluate everything that they've built or everything that they've adopted for purposes of helping them in their discretionary risk taking. I think that's actually a big question. I'm disinclined to change my behavior, but I'm open-minded about it. The second question that I respond to your question with is about what's not really talked about too much, and in the text of the Axel Rosenberg order, but is, you know, clearly an underlying issue, and that is there's something going on about protecting our IP that was a function that was related to the nature of the control processes that were built around the model update process. That is, and so how do you factor in the trade-off between protecting the IP, which presumably is a source of, if it remains protected, a source of positive alpha for the clients and abnormal return for the equity holders versus the incremental error that may arise from not having the same level of procedures and policies around the modeling and model updating that you could have if you did not have any concerns over protecting the IP. And again, I just want to say, and if you just read the text of the Axel Rosenberg thing, they have painted such a artificially black and white picture that these kinds of questions, which I think are more subtle, don't even seem to fall into the issues at hand. But I think for the rest of us, these are more like the issues at hand and not the picture that was painted in the order.
But and I'll ask you, Giovanni, but who tests? In the post-AXA world, who is responsible within a quant shop for testing and ultimately for making a decision about disclosure? How does this function work? I mean, Gianni, do you have an answer to that? Is there an answer from Europe? Is it the CRO?
I don't know if there's an answer for you, but I guess the ultimate decision has to be with the senior management of a firm. Who tests the models? Of course, the first people to test them are the people who are putting them in place in the first place. Can validation be done externally within the firm but by an external group? To a degree, yes, of course. What issues that bring along? Well, Barry just mentioned it, a couple that are quite substantial. It's very difficult to imagine a process that will answer this in anywhere near perfect way. I think there are satisfactory ways to arrange this that gives senior management enough comfort that models that are in place have been not just, again, tested by the people who have obviously an interest to make them work, but not necessarily entirely, on all fronts, and that have the compliance function within the firm and model validation function within the firm has enough reassurance that things are working. I don't believe that can happen by reading codes of lines of code. Again, Barry made a very, very good point at the beginning when he said that all kinds of programs have bugs that carry on for years and years and years and not discovered, despite the best intention, of course, of the programmers that put them together. So can an external team find them? Yeah, possibly. I think the best, unfortunately, in many ways, the best judges for this code are the people that produce them themselves and understand really how they were done. The other thing that I should say is also, and again, I'm echoing again something that Barry said, by reading the statement of the SEC, it is a bit concerning that, for instance, the part of the actions of AXA were represented as deliberately being opaque, hiding behind models because that's a way in which the quants use. There was a generalization there. And again, whether it's right or wrong, I think the thing that concerns me most about that is, again, the view that gives of the people who wrote it, that they may think that quants are really trying to do things really not, to use quant to hide things. And I generally think that is, but in the vast majority of quant cases, not the case, or at least not what quants try to achieve. I don't think that Rosenberg, in any shape or form, were trying to be opaque so that they could fudge or conceal their errors in any way or form.
I agree. I mean, I can see other interpretations for their actions that are quite consistent with what within a standard error. Models are necessarily imperfect, but that does, to me, raise the question of a possible industry response. And the reason it raises that question to me is that if what we're hearing, Glenn, about sort of the SEC's perspective is accurate, an industry response which is both responsive to disclosure and escalation, but also serves a little bit of the role of education about the function of quantitative models and different types of quantitative models, from high frequency on the one end to fundamental on the other end, that may be helpful in the process, may be helpful in tamping down some of the concerns that I think have arisen in the last few months in the wake of the settlement. But let me turn this over to the audience if you have questions for the panel at this point. We have a number of minutes left. And then the back there. Yes, yep.
Panel to respond further to the thought of what is the purpose of a model. And I think I don't share the view that all models are necessarily wrong. Rather, I would restate it as models are simplifications. And the question then arises, are the simplifications in that model appropriate to the complexity of the situation? And I want to just invoke a really excellent paper written by one of our senior fellows at the IAF, Emmanuel Derman, on model risk, which I think is a very powerful and articulate statement on this issue. So, I want to tackle that.
Barry, you want to try to?
Gee, thanks, Peter.
This is my privilege as moderator.
Okay, so so first of all, what I would like to do but can't, because you asked the question, is say that the question is out of order with respect to how I want to treat what Axel Rosenberg opens up as issues for us. Okay, I'd like to be able to say that. So because otherwise you really do have, if I don't think you have a defensible position, honestly, because to say that you want to treat a model as a suitable simplification of reality, and its suitability is defined with respect to its ability to accurately describe some subpart of a more complex process, okay? But that accuracy is itself only maintained as long as some underlying complex dynamics continue to work in such a way that your simplification continues to seem to perform. It's very self-referential, and presumably then, when the model stops performing in the satisfactory fashion that you found it to be, you'll throw it away or revise it and have a new model. And because the new model will now be the one that does that, emulates that subsystem of a complex dynamic in a way that seems reasonable for now. And so you can see, especially if you're a little bit of a anti-scientist, that this is just an invitation to see everything as being potentially a gigantic, misrepresentation of reality. And therefore, that opens up the scope of something like, in my mind, okay, maybe I'm being a little bit hyperbolic here, but opens up the scope of something like this Axel Rosenberg thing, like far too wide for me. I would rather, I'm okay actually saying, subject to a bunch of caveats, I'm modeling this part of the world's process, and seems to be okay. And I've done a bunch of good back testing, and I seem to be able to make money using this model. I'm okay with all that, but I just don't want to be thinking of that in terms of making assertions about what's true, what's an accurate representation of the world, what's an error with respect to representing the world, and what I happen to say about it. Did that make any sense at all?
Anybody else on the panel?
Yeah, I
like
think
to
it does.
respond?
And I think to some degree, whether the model represents reality fairly or not, as Barry just mentioned, is to a quant manager is less relevant than whether it accomplishes a number of other factors. And by contrast, the model that represents reality fairly may be of hardly any use, or accurately may be of hardly any use.
Questions?
I haven't read your model conform to their own intended representation of reality, as opposed to whether the model properly implemented would have been a good representation of reality. It seems to me that is something you can say. That's is that correct, I guess? The other question I have is there anything in this statement that called into question the review process on the fundamental process grounds, lack of number of staff, quality of staff, lack of documentation, regression tests, or such things?
And I think, and I'll let the panel answer as well, I'll take a cut at that myself. I mean, I think that there's no question that the SEC raised questions about model review at Axel Rosenberg. To me, one of the interesting features of the settlement was that the reimbursement to investors was dated from the date that the model went into production, the error went into production, April 07, not from the date it was detected, June 09. And they cited, as Barry pointed out, that the compliance program did not find the error. And I wouldn't be surprised if any compliance program didn't find any particular error. So that aspect of it was somewhat troubling or surprising to me personally. I don't know if the panel has other responses on that point.
I mean, I think it's hard to necessarily draw the conclusion, even from the order, which is a very one-sided document. It's hard to draw the conclusion whether Axel Rosenberg was reckless. And I think that's one of the disturbing things about the case. If it was very clear that this was just completely an outlier, then we'd all kind of go on our way. I don't draw that conclusion necessarily. I don't know what the panel thinks.
Other questions? Ben?
In the discussion up till now, we've been talking about the model, but we haven't distinguished how the model is used in the business process. And I think this is people's thoughts about distinguishing between a model, let's say a high-frequency model, which by its very nature does not allow for sort of human oversight and management, versus a model for a monthly rebalance, which goes through a review process where before the trades are executed, people review them for reasonableness and then approve them. Because it seems to me that it isn't so much the model, but whether or not you have something which is, whether you substitute your fiduciary duty in the creation of the model or not.
I think that's a very, very good point. Anyone on the panel like to respond to that?
I mean, I would agree. I think it's a really good point, and I think it also highlights the kind of lack of one-size-fits-all here. I don't have anything to add other than that.
I mean, the order does say in a couple of places that the compliance program is supposed to be designed to be to correspond to the particular risks of the business that is being conducted, and so in that sense, it's going to be different for different organizations.
Yeah, I mean, as they say in the press release, procedures must be tailored to the risk of the model's strategies. So it's really very business specific.
So a question a hand over here, yes.
Seeing that if you have a model that, as was possibly indicated, may be rebalancing under, so there possibly is sufficient time to look at it. If in fact one would be looking at a weighting model on some percentage basis, as long as something was between 0 and 100%, it probably wouldn't stop anybody from using it, because that was expected. So there probably are a series of things that would have been viewed as okay for this model unless you somehow redid the computation, which is undoubtedly complex, over again, assuming even that the computation is not correct. Some of these things, for their very nature, again, the high-speed trading, are things that will be flashing by to the point where even if they were detected, it's too late.
Although certainly on the high frequency trading, you do have testing on the before you implement. You do have controls in terms of monitoring what you're doing, and you're looking at it on an ongoing basis. It's not totally devoid of. It's different than the type of other example, but it's not totally devoid.
And
Here, I'm sure that all high-frequency trading models aren't of the same ilk, so to speak, and there could very well be a collection such that for each time anything changes in the marketplace that it's viewing, that there will be a new number that shows up, and by its very nature of being high-frequency, not be that high, unless somewhere else there was something running to catch it.
Well,
Originally, when NASA had these kinds of problems, we landed on the moon the first time, because somebody went overboard to try to control the code they were using to make sure the thing ran as fast as it could. There was an idea that the redundancy ended up becoming not only for computers, but becoming languages. Because here, there was an error that could not be detected by the compiler because it was a valid statement. But instead of having 10,000 iterations be done, one was done. And which caught them, 50 feet above the moon? And there was just some scrambling to jump into the pilot seat to land the thing manually. I mean, we don't have that kind of process here. We couldn't.
I think the challenge is to not assume that you're going to be blessed with perfect hindsight before the fact, and to adopt what Glenn described as a reasonable set of policies and procedures for tracking, identifying, and correcting these kinds of coding errors.
We have time for one final question, if there is one. Right here in the front.
Okay, I believe, you said that based on the survey that you did, there's no set definition of what constitutes a model and an error based on the responses you got. So is it possible to set an industry standard of what actually makes an adequate compliance program that different companies can use, utilizing that sets the industry standard for what's considered an adequate compliance program?
So just to repeat the question, to make sure everybody heard it, based on our survey, which didn't give rise to real clarity as to what the definition of an error was, is it possible to come up with an industry program, an industry standard to define errors? Is that the question?
To set like an actual compliance, like an industry standard of what an adequate.
To set an industry standard of an adequate compliance program? I think that's a very good question. And I don't know if I know the answer to that. I'd be interested in Glenn's answer and interested in if there's any further reaction from the audience on that question, because I do think that there may be a potential here to, and I note your hand, there may be a potential here for the industry to do something collectively.
Well, I mean, aren't standards ultimately least common denominators? Because you have to find something that applies in the most general sets of circumstances, and then then I think it creates some moral hazard, at least, I mean, at a certain level, in terms of, well, I complied with all of the compliance standards bullets, rather than realizing that what we're talking about are, I mean, there are certain things that, like, we don't need an industry standard to talk about, it's a really good idea to track code changes. right? So the question is, what do you get if you have an industry standard that says it's a really good idea to track coding changes? And if you try to get very granular in that regard, then either you miss all of the idiosyncrasy in the kinds of issues that arise in different environments, or you tend to suppress the kind of innovation which you might like, which would manifest itself in terms of idiosyncrasy.
I agree, there's no panacea.
Well, the other problem is the flip side of that, which is standards somehow kind of ratchet up to become best standards, and then they get really applied down to people who they may not really make any sense for. And so you're spending a lot of money on things that really you're not getting much bang for the buck. And then you also have the issues where you maybe aren't doing the things over here that you should do because you spend all the money over here. So it's difficult.
Giovanni, from the experience in Europe, there were, if not standards, at least some discussions about principles.
Yes, not in quant space, the model, but in the example that I mentioned earlier on. In fact, there were standards that were put forward, and I shared the views with respect to those standards. For instance, coming from a shop that, as I said, it was a more boutique size as opposed to a larger shop, that a lot of the standards that were put forward were one size fits all and didn't quite fit the size of some of the shops on the spectrum. And I agree with what has been just said, that keeping up with innovation is very, very difficult. And so models are all new. We talked about high frequency models. They're totally different from the traditional quant models, regression-based, that are presumably used in this case.
Right.
It's just the comprehension, the understanding of the issue is difficult enough.
There was a hand over here. Was it related to this topic?
Just understand. It's sort of going back a little bit, a couple of questions, but in terms of, because to create standards to define errors, the first thing you need to define is what's the correctness of the model, right? Which is what the problem is. How do you define a model to be correct? And then you get into this argument that you can't really represent the whole universe to all the details, so you can always compare it. But would you think it's reasonable to define, now the great majority of funds represent some sort of strategy to their clients, right? This is the universe you're playing, this is the kind of return you're seeking, this is the risk parameters that you're looking at. If you define the correctness of the model as accurately, as reasonably accurately representing the strategy that they're selling, then it becomes something where you can actually define errors much more easily, and it's something that is more enforceable both by internal controls and to some extent.
Do people do that? Do people define to their investors, do the funds define to their investors that level of detail? My clients don't, but I don't know if others do.
It's an interesting point of whether you should disclose, and if I understand your question correctly, whether you should disclose and to what extent you should disclose the presence of model risk in what you do, and whether it's emphasized or not in in your presentations. My personal opinion, again, I have no knowledge of the Axel Rosenberg literature in this case, or whatever they produced, is that the majority of quant managers make reference to the fact that there's model risk.
I thought the statement wasn't so much disclosure of risk, which I think you certainly should do, but was to basically say the model does A, B, C, D, E in a very, very specific way, and then if the model doesn't do that, that's an error. And I guess all I was saying is I don't know that people necessarily describe their strategies with that degree of specificity that you would be able to then say it didn't do what we said, unless, of course, it's a huge mistake. I don't know, maybe I've misunderstood what you said.
You have lots of funds that may not be the hedge funds, they're not index funds, but they're benchmarked to something like this. So they, they will usually say that they will invest to try to track an error within certain parameters and take so much risk, but this nature of that nature. And you can monitor that.
Yeah, and
that the models do a reasonable job in.
And that's relatively clear, I think. I mean, if you say we're investing in technology companies and your model somehow you're investing in, Exxon or something like that, it's just a complete, coding mistake, and it cost you a lot of money. I mean, that's an error, and that's very simple. I don't know enough of the facts behind AXA Roseburg to know if what the SEC was looking at was that simple or not. I suspect not, but I don't know.
Well, we will have to, unfortunately, end the session at this point, as we're out of time. But I want to thank the audience very much for your participation, and I want to thank the panel very much for your time and the participation this morning. Hopefully some of us will be able to stay around for a few minutes to answer any questions individually. Thank you.
Hi, so we have a coffee break. We're going to run until about, so it's 10:38 now. If you want to, back in 405 and 406, the rooms you were in before for registration, we have fresh coffee, so go stretch your legs, get some coffee. We'll be back here at 10:50 for the next session. Thank you.